The themes that we are going to be focusing today morning are going to be on the global growth, the liquidity crisis, the role of sovereign wealth funds, and the oil issues and currency, which we thought would neatly summarize some of the most important challenges today morning. Well, it's a world which is getting scared by US. As you can see, the prognosis as of today, the consensus forecast for the growth on the US is considerably lower than what it was 6 months before and what it was 12 months before. So we are talking about just a shade below 1.9% for 08 for the US. And Eurozone is holding up, but Asia is certainly trying to move in the opposite direction. So we are having a situation where the global growth is expected to grow at 4.1%, and the whole world believes that US is going to slow down, but it's just a question of by how much. Inflation is definitely a concern, as we can see today. The action of the Fed to lower the interest rates only by 25 basis points and not 50 basis points is primarily because of this concern. We feel that emerging markets still are on top of the peg when it comes to inflation, but it's a key concern for the monetary policy makers today. Well, this is going to be the heart of the debate. Is this world coupling or decoupling? There is this new theory that is going around that regardless of what happens to US, the Asian markets will continue to shine. And there are some statistics here that shows it's from the same research agency, which is Goldman Sachs. The two charts are quite contradictory to each other. The chart on your left shows that there is going to be a great coupling that's going to happen in terms of global growth, as you can focus your attention on the gray, which is the 2008 less 2007. This is actually the delta of growth. And there is going to be a delta in US, and that will be consecutively followed by deltas across the world, which means the world is not decoupled as we all believe. But on the right-hand side, from the same Goldman Sachs, the contribution of the emerging markets to global growth has grown phenomenally within a span of 5 years. The two bars represent one for 2000 and another for 2005. And in 2005, the world is more dependent on the Asian markets for growth than US. So this is, I think, is one of the themes for debate that we will be curiously looking forward to know as to whether the world is coupling or decoupling. Well, from a return on equity point of view, the correlation has been almost rising all the time, which again points to the fact that they are not two different isolated worlds. So here is a chart from whichever way that you look at it, for whichever period that you look at it, the correlation of return on equity of the Asian markets to the global markets has been increasing, which means another serious point towards coupling rather than decoupling. The second issue that we are going to be discussing would be the liquidity crisis. As you can see, the world is awash with liquidity. We are showing here some statistics on the foreign exchange reserves, where Chinese foreign exchange reserves stand at more than $1 trillion, followed by the big guns. And you can also see some of the GCC countries, especially Saudi Arabia, UAE, and Kuwait, also joining in the race in terms of the liquidity. There is a swash of liquidity sloshing around the world, and there is a crisis in terms of subprime, which is the talk. And you can see the impact of this subprime crisis on the housing sector, where the S&P Case-Shiller index is not finding any space in the graph to go down. So that's the speed with which it's going down. But there are certain countries, especially UK, that is holding up. And we would like to see and debate whether the crisis is just the start or it's nearly come to a maturity stage where we don't have to worry anymore. Well, the central to all of this action, as we are sitting here, is the oil price. All of us know that oil prices have moved to a new strategic band. For a very long period from 1991 to 2004, it stayed in a band of 10 to 30, and then it broke loose. Even you can see the moving average broke loose. That shows the speed with which oil prices have been climbing and the consistency with which it has been ferociously staying in the new band. So the panel would like to debate as to whether this is a strategic new band that we can all expect to stay for years to come, or are we going to just see a major correction? The good news for the GCC and the bad news for the world is that oil production isn't getting any better. As you can see, the CARG, the compounded annual growth rate in the oil production, has been just 1% over the last 5 years. So it's a world where oil is not being produced much, and probably that is one reason why oil prices are staying much higher. And the fourth major theme that we'll be discussing in the morning would center on the currency. As we can all know, it was a year in 2007 where dollar took a brunt, and the consensus opinion is that it will continue to slide. But which is the currency that is going to get to be on the other side of the story is the question. The Asian currencies so far have been holding a bit better than euro, but as you can see here, it's time for the Asian markets probably to take some of the hit. And finally, how all of these major global issues and challenges would affect the behavior of institutional investors. I think that's probably the heart of the debate that we are going to be seeing here. We are just presenting some of the asset allocation habits of global institutional investors. On the very first bar, you have insurance companies, which by mandate have to be overly exposed to bonds. And then you have the pension funds, which are quite aggressive on the equities. And just as a matter of example, we have given you the asset allocation of Harvard Business School. The negative 5% indicates their exposure to absolute return strategies. But again, the point is it's a world where institutional investors, except for insurance companies, look heavily towards equities for sustenance and growth. One of the major dimensions of asset allocation spectrum is the over enthusiastic interest in the alternative investment space by the institutional investors. We have given some statistics from IMF here, which shows the preference of institutional investors towards alternative investments. Especially, you can see the role of real estate among the alternative investments. We have tracked real estate, private equity, and hedge funds. But what's very interesting is the role of real estate, the increasing allocation by institutional investors to alternative investments, and within alternative investments to real estate. But global institutional investors continues to be very highly biased towards their home. As you can see on the graph towards your right, the exposure to foreign securities by these global institutional investors remains pathetic at a level of about 10 to a maximum of 20%, which means there is a lot of home bias by global institutional investors, and it continues without any change. Now, the panel will also very quickly look into some of the challenges which the region faces, probably taking cue from the global challenges, but certain challenges are quite homegrown. Now, we are going to be really focusing on the region here, and when we say the region, we are defining the region to be the Gulf Cooperation Council countries, which you can, as you can see here, is a very, very tiny fraction of the emerging market space. Even if you take it from a demography point of view, it is just hardly 5%. But look at the economic representation of the Gulf Cooperation Council countries. It gives a run in terms of the current account balance, in terms of the per capita and what have you. So there are some structurally very interesting issues that emerge out of this. The region, just like emerging market, has been growing at a very strong pace and is continued to grow at a very strong pace, as you can see here. All the 6 GCC countries enjoy very high growth rate. Qatar is a good example of an economy that is growing in double digit in real terms. Inflation is a major concern. As you all know, that some part of the inflation story is domestic and some part of it is imported, and policymakers are really having a serious problem due to their currency peg on how to tackle this inflation. The region is like the global liquidity market. The region is also awash with liquidity. Look at the growth rate in the M3, especially for Qatar. It has reached now nearly 40%. And almost all the GCC economies are really facing huge liquidity pile. We have presented some of the Economist Intelligence Unit risk ranking of these countries, because outside the region there is generally a perception that all the GCC countries are do score very high on the risk measure, but not necessarily, except for Iraq. I think all the GCC countries are very much in tandem with even say countries like Australia or Taiwan or Hong Kong. And we wanted to take a look at what is the level of institutional investment, which I think is a very important dimension for the morning panel. As we all know, the level of institutional investment in the region is extremely low. It's just 5% compared to 75% in developed markets. That is the main reason for that is the institutional investors, who mostly happen to be mutual funds, is a segment that is just not taking off in the region. Of course, on the other side of the institutional spectrum, we have sovereign wealth funds. You can see it is rumored that Abu Dhabi Investment Authority manages something close to 650. This number keeps changing every 3 months as I read newspapers. And we can also see here the Russian sovereign wealth fund, the Norway sovereign wealth fund. But these sovereign wealth funds have created a lot of interest in the region, primarily because of their asset allocation habit. As you can see here, we are showing you the asset allocation structure of the Kuwait Investment Authority, which is quite loaded towards equities, 57%, and towards US, which is 52%. But a recent report in the newspaper says that KIA would like to have an exposure of about 20% to emerging markets. So that is the shift that is happening among the sovereign wealth funds. And when they mean emerging markets, probably they are looking at GCC as well. Well, the region faces a huge challenge in terms of evolvement of regulatory gap. We have done research some time back to score all the emerging markets and the GCC markets on the regulatory scale, and none of them are scoring much above some of the countries, the exception being Egypt. But the closest that comes to our notice is UAE, which scores 5.1 on a scale of 0 to 10. So from a regulatory evolution point of view, I think there is a big gap. And finally, the region is faced with a huge challenge of managing this growth. It's already translating into $1.5 trillion of investment, but the good news is these investments are spread much better this time around than last time in terms of its exposure to various sectors. Predominantly construction happens to get the lion's share of all the projects. We have some of the currency experts here to discuss as to what shape these lines will take in 2008. We have shown the Kuwaiti dinar breaking away, but Saudi riyal holding back. And this is the dilemma that the region faces today. Yes, there is a lot of liquidity, there is a lot of oil wealth, and there is a huge paradigm shift. Things are different this time. This is the consensus opinion, but do we all agree? That's what we are here to debate. It's been a very sorry year for mid-cap. Those who have been betting on the mid-cap must have really rued the fact. Across the size spectrum and the style spectrum, the mid-cap has not been doing well. But go back to our chart one, where in the long term, mid-cap has been the best performing asset class within US. Small cap value, as you can see here, over the last 5 years have outperformed significantly, but for 2007, it's been minus 3%. So there has been a very good change of course in US. What used to be a small biased, a value biased type of an approach is now shifting to growth bias and large bias. So our debate will focus on whether 2008 is going to be a growth type of a story, and is it going to be a large story as well. The earnings performance, as you can see, we have got a statistics that runs back to 1984. It peaked in 98 to 2000, and then it's all been on a downward trail irrespective of the asset class within the US. But we can see that during the last 4 years, it's been on a very steady state of course. We shift our focus quickly to Europe and Far East, which is generally referred to as EAF. The long-term EAF performance has been that EVE as a composite asset class has managed to outperform the subcomponents within EVE, as you can see here. But for the year, it's been a year for Germany, definitely clearly ahead of the pack. It's up by 22%, whereas Japan, while by the mid of the year it was okay, but it started receding very quickly, and now it's the worst performing market for the year. All right. Now, what are we seeing here? We are seeing a situation where we are trying to benchmark the current valuation with respect to the historic average, which is the 5-year average. And almost all developed markets, as you can see here, are the current valuations are quite attractive compared to the long-term average, which means they are good bargains, except for the first one, which is Canada. This chart is very important because when we come to the other slides, probably this will make a lot of sense. Within the emerging market, I think the BRIC is certainly on the rock and roll type of a situation. The Brazil, Russia, India, and China together, I think as a group has delivered about 65% for the year, probably more as we speak now, and followed by Latin America. And emerging market, even as a composite group, is closely about the worst performing block within the emerging market is the Eastern Europe. All right, this is extremely important. What's been happening is a convergence of valuation. We have statistics from 2002, and you can see here the price to earnings trend for mature markets and the emerging markets, how dangerously they are converging. Today, emerging markets are at a premium to mature markets, which I think the speed with which the gap closed is causing a bit of an alarm. Well, this is research that we published a month back now, where we tried to see whether we were inspecting the possibility of a bubble forming in the emerging markets. This chart shows the classic bubble to bust histories of some of the classic bubbles that happened in the past. As you all be very well aware, Nikkei and Nasdaq are good examples in the past. And typically we figured out that it's a 9-year cycle for a bubble to mature and bust. But we do have some sort of an experience regionally in terms of Saudi Arabia, where it also went through a bubble to bust phase. But it's one of the shortest lived bubble to bust examples. It lasted about 2 years, so not 9 years. And we have now superimposed on this how China and India stacks up in terms of the speed with which they've been going up. And we find that both of them are as closely positioned as the mother of all bubbles. And here is the statistics on what is causing these bubbles. Obviously, the best case guess is that it's a hot money. Hot money is frequently referred to as the foreign institutional investors' money. For example, look at China. For a period of 25 years, it received the hot money of about $1.5 billion every year. And all of a sudden, in 2006, it received $43 billion. So that's the shape of things that are propping up these markets. And as I invited your attention to the same chart that I've shown for the developed markets, almost all the emerging markets are way above their 5-year averages. None of them are exceptions. This is just quite a contrast to the developed markets, where almost all the markets are available at a discount to the 5-year averages. Okay, what about volatility? We run something called as a volatility index at Marcus, where we have developed a proprietary program to measure volatility in the form of an index. One thing is, we found that the US market volatility has come down relative to it has gone up in 2007. As we can see, we measure the last 12 months here, and the emerging market volatility for 2006 has been lower, similarly for the 2007 as well. Now, what's been happening? There has been a lot of talk about emerging market correlation. One of the greatest attraction of buying into emerging market is that it was believed to be least correlated to the developed markets. While it was true in 76 and 85, when correlation ranged 40%, then the correlation moved to 60%, and now the correlation is about 80%. So we have to sincerely debate as to whether emerging market is a correlation story at all. All right, so we have just sizing up here the world markets, where we have seen that in general it's been a bit of a volatile period for the developed markets, but a great year for emerging markets. All right, let's turn our attention very quickly to the region as to what happened. The region, when I said, it's GCC, the 6 countries that we are talking about. Well, it's been a very good year, but a volatile year for most of the markets. On a long-term basis, which is the last 5 years, Kuwait has been the best performing market on a risk-adjusted basis, as you can see in the chart on the left side. But for the current year, I think it's the small markets which are Oman is the best performing market. Kuwait has been the best performing market up till July, and then it turned course, and now it's one of the most volatile markets in the region. Okay, what about the volatility? Unlike the developed markets and the emerging markets, where current year volatility is much higher than the last year, GCC markets just exhibit the reverse trend, where the last year's volatility was higher than the current year. On the valuation front, most of them are quite attractive within the 14 to 16, 17 range. But the best part of it is that the earnings continue to grow at a very, very healthy rate. As we can see here, what we measure as the prospective earnings for 2008, most of the markets are expected to be very strong in terms of earnings. So you have a reasonable valuation supported by very strong earnings. This is the PE band. This is a bit of an interesting chart because there are some markets within GCC that are perceived to be more volatile than others, especially Saudi Arabia and UAE, where you can see the band to be very high. But look at the average. While the band may look very stretched, the average is still reasonable, which means that the spike in the PE was a very short-lived one. So there is nothing to really worry about it. The markets definitely went out of bound, but it didn't stay there for a long time. As I have told you in the bubble chart, the shortest lived bubble to bust story happens to be Saudi Arabia. Well, what is very attractive is the combination of the current account surplus and the PE ratio. We have just plotted some of the emerging markets with the GCC, and we come up with 3 situations where we have the best scenario. The attractive quadrant, as we call, is the one with the highest current account surplus and very low valuation. So most of the GCC markets, in fact all of the GCC markets, plot in that attractive quadrant. Look at China. All right, we have seen the correlation story breaking up for emerging market, but they are getting better and better for GCC market, simply because they now have a negative correlation, both from a short-term point of view and from a long-term point of view. The GCC markets are to the extent 25% to 30% negatively correlated with emerging markets as well as developed markets. It's been a happening year for IPOs. Look at the statistics here. We have on the left-hand side the number of issues which zoomed from 47 to 62. But look at the average oversubscription, which at one point of time used to be 41 times, is now just 13 times. So is it signaling some sort of a maturity on the part of investors? I don't know. Some of the companies that have performed really well for 2007 comes from Qatar. The industry's Qatar has been the best performing stock among blue chips. It's up nearly 88%, followed by the Qatar Commercial Bank. Look at SABIC, which is at 54%. It's the largest capitalized stock in the region. We are not going to be spending too much time on this, but nevertheless, this being a very large asset class where most of the institutional investors are concentrated, we would like to see what's happening on the bond front. Of course, we know that the bonds are a lousy asset class from an investment perspective, but it's been a case where the rolling one-year return has been coming down year after year. You can see the nominal yields between the corporate and 10-year treasury coming down quite drastically, and so is the case for the investment grade corporate bonds. Falling yields on the bonds certainly have created a lot of uncertainty for the asset allocators in terms of the exposure. Especially, I think it puts pension funds in a very piquant situation. High yield has been performing badly in the recent times, but for the last 12 months, they've been okay at about 7%. And even better if you go for 5-year frame or a 10-year frame, they are not bad. On the real estate side, we've already seen in the morning that this graph has been causing a lot of concern. As we can see here, it's been a very roller coaster period for real estate in 2007. The REIT's performance, if you take the Marriott rolling 12 months return, they have ranged for 2007 between practically 0 to about 20%. But look at the performance of Marriott equity index relative to other asset classes like S&P 500 and Russell Growth and Russell Small Value. It's been a sharp reversal of performance in the last 3 months. This is the story of the yield. The cap rates have been coming down quite significantly for the real estate, as you can see here. For the first time since I think 2000, the cap rates have broken and started going down. That's a very sharp downturn in terms of the earnings yield. It's been a very, very mediocre year for hedge funds. People that have put a lot of money must be not very happy with the performance of the hedge funds. They averaged about 6%, and apparently with a lower risk, which I refuse to buy. Commodities, it's been a year of commodities as much as it's been a year of emerging markets. As you can see here, the gold, the silver, and the Dow Jones AIG Commodity Index, which is a much more balanced index than the Goldman Sachs Commodities Index, has gone up by nearly 22%. This is the breakaway, very similar to oil prices. As you can see here, commodities have been range bound since 1982 up until 04 for a very long time, and then it broke loose, just like the oil price. We can see a good similarity between the two. It's been a good year for private equity purely from a money raising point of view. You can see that already for 2007, I think these are estimates up to September, they have surpassed the amount that they have raised in 2006. But the bad news is that they're having a hard time finding deals. So this is what we are up to now, and the floor is back to Richard to fill this. Thank you.
Raghu, I mean, you were the one that came up with this slide. Do you see, and anybody else for that matter, do you see there being a new price band, maybe in the, what have we got there, the $60 to $80 range? I mean, do you think that's where oil's going to be now for the next few years, or?
Very concerning this time is that most of the oil producing countries are not focusing on seriously increasing their spare capacity. I've just read a report in Economist which said that Venezuela, for example, they're very happy spending the oil money on political issues than creating new capacities for production. Now, there might be a vested interest in doing that to just keep the oil price at a level that will comfortably see them through, because they've done the mistake in the past where when there was a boom, they invested in creating capacity which brought them down and kept them there for a very long period. So probably I would like to know from you whether, is this a serious imbalance that is getting created from a long-term perspective on the supply side? Because we are all very familiar on the demand side. I mean, what can go wrong and what can go right, but there is not that much of a clarity on the supply.
If we look at the numbers, what percentage of the money that is invested in the Kuwait equity market is institutional?
Of calculating this number of institutional management is very tricky, because we are talking only about the mutual fund segment. We did recently a study on the Kuwait asset management industry, and we figured out that 90% of the money in Kuwait is being managed in the form of discretionary portfolio management and managed accounts.
Sure.
So this is probably the case in Saudi and other places as well. So what is being captured as a measure of institutional investment is not absolutely correct. And again, we are going back to the problem of statistics.
Yes.
MSCI has recently stated that probably in the next 1 year, Korea will be out of MSCI Emerging Market Index and will move to the Developed Market Index.
and the share of BRICS will then move from 25% to 55% of emerging markets. So that has huge implications, I believe.